Hello students, I am Dr. G. Manju, Associate Professor and Head, Kung Arts and Science College, Erode. Today our topic is Basic Understanding of Accounting. What is accounting? Accounting is the process of recording, classifying, analyzing, and interpreting the business transaction, which can be measured in terms of money. Accounting keeps a permanent record of all business transactions. Accounting helps in knowing the true financial position of the business. Accounting provides all valid financial information to owners, banks, customers, government, and other outside parties to make correct decisions. Process of accounting. Process of accounting has a several steps. First step, business transaction. Every business entity record all financial character or even in the day-to-day transactions. Second step, journal entry. Journal entry made by as per the double entry system rules. And third step, ledger accounts. Ledger account prepared by classifications of different accounts such like that nominal account, real account and personal account. Fourth step, we move to the trial balance. Trial balance, nothing but it is extracted or balancing figure of each individual ledger accounts. Then we move to the preparation of financial statement, that is called it as final accounts. Final accounts classified into three. One is the trading account, second one is the profit and loss account and balance sheet. Basic terms of accounting. Assets. Assets are resources owned and controlled by the business enterprise. Example, land, machinery, furniture, cash, bank balance, stock, etc. Types of assets. Assets classified into three categories. One is the fixed assets, second current asset, third one is investment. Fixed assets. These are assets purchased for a long period, that is more than 1 year. Example, land, building, plant and machinery, vehicles, furniture and office equipments, etc. These assets form the basic infrastructure of the company. These assets are not held for sale. Current assets. These assets are required to carry on the day-to-day business activities. Example, inventories. It include raw material, work in progress and finished goods. Cash balance, bank balance, debtors, receivables, etc. Investments. When a business enterprise put its surplus funds in shares or bonds of government, it is known as investment. Investment generate the income in the form of interest, dividends, etc. They generate gain or loss when sold. Liabilities. Liabilities are obligations of the business enterprise payable to outsiders and to owners of the business. Example, owners' capital, borrowings, creditors, payables, etc. Types of liability. Liability has two types. One is the long-term liability, another one is the short-term liability or in the current liability. Long-term liability. Any liability payable after a period exceeding 1 year. Example, owner's capital, bank loans for more than a year. Current liability. Any liability payable within a year or liability incurred in day-to-day course of business. Example, creditors, payables, bank overdraft or short-term credit, etc. Balance sheet format. Balance sheet is classified into two columns. First column liability is available in the left hand side. Second column assets is available on right hand side. Liabilities further classifications to one is the owner's capital, another one is the outside liability. Assets classified into three. First fixed asset, second current assets, third one investment. Balance sheet balances always equal to both the sides. Financial position. Total asset equal to total liability or asset minus outside liability equal to owner's capital. Financial position is said to be stronger if the assets are more than outside. Basic terms. First, income. Business activities generate the various types of revenues and incomes. Thus, income is what the firms earn. Example, income from sale of goods, fees from sale of services, interest and dividends on investment, cash discount, rent received, gain from sale of investment, etc. Expenses. Many expenses are incurred in the course of business activities. Example, raw material purchase, wages and salaries, power and fuel, office rent, advertisement expenses, loss on sale of investment. Financial performance. Excess of income over expenses is known as net profit. Excess of expenses over income is known as net loss. Every business tries to earn profit. Net profit is added and net loss is deducted from owner's capital. Asset minus outside liability equal to owner's capital. Capital plus net profit. Capital minus drawing plus income minus expenses. Accounting process or cycle. It has 6 steps. First one, analysis of business transaction. Second, documentation. Third, recording. Fourth, classifying. Fifth one, summarizing. Sixth one, bifurcating. Business transaction. That means every business entity record all financial character or even for everyday transaction in the business. Next, we move to the journal entry. Journal entry made by under the double entry system rules. It is a documentation and recording work. Then second is a continuity of as per the journal entry, we move to the preparation of ledger accounts. Ledger accounts classifying the various accounts such like the personal account, real account and nominal account. Then we move to the trial balance. Preparation of trial balance is nothing but summarizing the balancing figures of ledger accounts. Then we move to the preparation of financial statement. Nothing but that is in final accounts. Final accounts classified into 3 categories. One is the trading account, profit and loss account and balance sheet. What is an account? An account is a device to record business transaction. There are various accounts prepared for each asset, liability, income and expenses. An account has two sides. The account has two sides. That is, left hand side we mention DR, that is an debit. Right hand side we mention CR, that is an credit. What is an account? The left side of an account is known as debit DR. The right side of an account is known as credit CR. In any account, on one side increase is recorded and on other side the decrease in the item is recorded. Types of account. It is classified into 3. First one, nominal or temporary accounts. The accounts related to all incomes and expenses. Example, interest account, rent account, salary account, etc. Second one is the personal account. Accounts of natural persons like Mr. Ramesh, Mr. Suresh, etc. Accounts of legal persons like companies, banks, government, etc. These persons are generally the buyers, sellers, lenders, investors, etc. associated with the company. In short, they are debtors or creditors. Third one, real or permanent accounts. These are accounts of various assets and goods. Example, buildings account, machinery account, debtors account, purchase account and sales account. What is debit and credit? Debit is the left hand side of an account. The amounts written on the left side of an account are called debits. Credit is the right side of an account. The amount written on the right side of an account are called credits. Debit balance and credit balance. Every account has a debit balance or a credit balance. Debit balance. An account has a debit balance when the total of debit side is more than the total of credit side. All assets and expenses have a debit balance. For assets and expenses, an increase is written on debit side and a decrease on credit side. Credit balance. When the total of credit side is more than the total of debit side, it is known as the credit balance. All liabilities and incomes have a credit balance. For liabilities and incomes, an increase is written on credit side and decrease is written on debit side. Rules of debit and credit. The system of accounting is a double entry system. Under the double entry system of accounting, every transaction has a two effects, one debit and one credit. This means for every business transaction, one account is debited and one account is credited. The 3 main rules for nominal accounts, that is income and expenses. Rule number 1, debit all the expenses and losses and credit all the revenues, income and gains. Second one, for personal accounts. Rule number 2, debit the receiver and credit the giver. Rule number 3, for real accounts, that is for assets and goods. Rule 3, debit what comes in and credit what goes out. Method of debiting and crediting. It is classified into 3 steps. First one, determine the accounts associated with the transaction. Second, determine the type of account, that is personal, real or nominal. Third one, record the transaction using the rules of debit and credit. So that's all about the basic understanding of accounting. See you guys in the next video.